Hello friends, David here. Welcome back to this YouTube channel. I know, it has been a while, right? So Tesla has just shared their Q4 deliveries not too long ago, and the numbers are nothing short of phenomenal. So in today's video, I'm going to share with you what this Q4 delivery means to the stock price. First of all, Q4 delivery is 308,000 versus 241,000, representing a 28% growth quarter over quarter. And if we just look at the full year, it is 936,000 versus 499,000. This represents a 87% growth. So what does it mean? So a lot of things. If we just extrapolate this 28% growth quarter over quarter into a full year, this represents a 109% growth. This is despite in a year with supply chain disruption, in a year where Giga Berlin and Giga Texas is not up to scale yet, in a year where there's a 1 year worth of back order. Despite all this limitation, Tesla is still able to grow at 109,000. But before I proceed, do hit the like button. This will help support the YouTube channel. And also do subscribe if you have not, so that you don't miss out content like this. In return, I will show you a cute puppy video. So to understand the impact, we need to look at two key things. Number one is capacity, number two is financials. In the near future, Tesla's demand will far exceed the supply, and therefore we can safely assume that Tesla's growth is purely determined from its production capacity, because demand is not a problem. And therefore, what this means is that if we're able to gauge how many cars Tesla is able to manufacture, this will translate to sales and therefore the stock price. These are the current Gigafactory sites along with the land size and the number of employees. If you just look at Fremont, it has a capacity of 600,000 with 10,000 employees, being an older plant, less efficient. If you just look at Giga Shanghai, despite being smaller in size, it's able to produce much more than Fremont because it's the latest facility. It has the Giga Press and therefore much more efficient and able to scale up much faster, despite having 5 times lesser employees. In just December alone, if you just look at Giga Shanghai, it's able to deliver 70,000 vehicles per month. And therefore, if you extrapolate it to 1 year, this means that Giga Shanghai can produce up to 840,000 per annum. While we do not know the production capacity of Giga Berlin and also Giga Texas, but if we were just to benchmark against Giga Shanghai, looking at the land size, the number of employees, we can safely assume that these two sites can at least double or triple the production capacity that of Giga Shanghai. So in my assumption, I think that it's safe to say Giga Berlin can initially produce 1 million vehicles per annum and eventually ramping up to 2 million vehicles per annum. And for Giga Texas, initially from 1 million, eventually it will ramp up to 3 million vehicles per annum. And therefore, based on these assumptions, we can safely assume that in this year alone, in year 2022, we can expect a 1.8 million vehicles delivery and also ramping up to about 6 million vehicles in year 2025. Current EBITDA is nothing short of phenomenal. It's at 23%. This represents a 77% growth year over year. This is of course because of the latest facilities and the scaling up. However, what is more special is that I foresee the EBITDA to be able to go up to 30% when 4680 battery is on board with Giga Berlin and Giga Texas fully ramped up production. This is because of the higher efficiencies and the lower cost of manufacturing. As we know, 4680 battery costs 50% less and the current cost of manufacturing is 70%. So if you reduce 70% by half, that is 35%. The current gross profit of Tesla is at 30%. So if you free up another 35%, this means that gross profit has the potential to increase from 30% to 65% because 30% plus 35%, right? But of course, I know the cost of battery does not consist entirely the cost of manufacturing. I'm just sharing that there's a room to grow up this much. Now, the current gross profit for Tesla is at 30% with EBITDA at 23%. This is without 4680 battery, without Giga Berlin, without Giga Texas. So imagine what would happen if Giga Berlin, Giga Texas along with 4680 battery is all on board. This would drastically reduce the cost of manufacturing and therefore increase the profit margin. It is safe for me to say that gross profit margin can at least increase to 40% and EBITDA at least increase to 30%. It is a very conservative number because, as we know, 4680 battery has already reduced the cost by half. For an automaker, having an EBITDA of 30% is unheard of, is unprecedented. In fact, it's almost like a software company. Just for context, PayPal, despite not manufacturing anything, has an EBITDA of 21%. And just for peer-to-peer comparison like GM, Toyota, they have an EBITDA of 15 and 16% respectively. Imagine with 4680 battery on board reducing the cost drastically, this would increase Tesla EBITDA to 30%, which is double that of GM and Toyota and something close to Facebook EBITDA margin. Putting these numbers together, how does it translate to the stock price? Given we know that the manufacturing facility, I assume that we will reach 1.8 million vehicles in year 2022 and subsequently 7 million in year 2026. This translates to a revenue of 314 billion by the end of year 2026, along with some contribution from the current FSD assuming a 25% uptake. Not the full autonomous FSD, the current version. Yeah? So I'm not assuming energy sector, even though we know that Tesla will 10x its energy production capacity from the current 4 gigawatt per hour to 40 gigawatt per hour. And we know that at the current capacity at 4 gigawatt per hour, Tesla energy sector has already generated a 28 billion in the past 12 months. So imagine we just do a rough calculation and 10x this amount from 4 gigawatt per hour to 40 gigawatt per hour, right? So if we were to just 10x this revenue, it will be a whopping 280 billion in revenue, just based on rough estimate. It's more complicated to calculate the energy sector revenue, and therefore I will just leave it as it is, and please don't take my assumption as it is. Please do your own due diligence, and I promise you, once I've worked out the calculation of the energy sector revenue, I will share with you in the future. Anyway, the projected revenue based on EV sales alone will be 314 billion. And if we were to just use a price to sales ratio of 7, the market cap would be 2.2 trillion with a share price of $2,000. This price to sales ratio is similar to that of Apple, and hence I think it is a fair multiple given that Tesla has much higher growth potential. How about the EBITDA multiple? If we just use an EBITDA multiple of 28 times, which is similar to that of Apple's, the share price would be 1,600 based on 11% discount rate. And the perpetuity method with a similar discount rate will be worth $970. What if I just remove the discount rate? The share price would be a whopping 2,700 per share, meaning that by the end of 2026, the share price would be 2,700 if based on these assumptions. All this is not including Tesla's energy sector, supercharger network, the actual fully autonomous FSD, and also the robotaxi. So based on my current valuation, Tesla should be worth 1,500 to 2,000 per share just based on EV sales alone. However, these are my personal assumptions and it's not to be taken as a financial advice. Please do your own due diligence and please do your own research. I'm not saying just for the sake of saying it. It's very important to do your own research and due diligence because it can save you when the stock price crumbles. In my opinion, Tesla will be a stock to hold during high inflation time, provided that the US economy does not collapse. During high inflation time, you want a company that's able to raise price and not lose demand. For example, like McDonald's. Even if McDonald's were to increase their price by 10%, you will still eat McDonald's, right? And number second, you want a company with high profit margin so that profitability is intact. For example, like a software company. And number three, you want a company with low debt and low capex. Why? Because during high inflation time, interest rate will also increase, and therefore this means that the cost of capital, the cost of borrowing money has also increased. This would in turn reduce the profitability and also reduce the valuation of a company. If you look at Tesla, Tesla has strong demand. In fact, it has 1 year worth of back order. And also it's still ramping up its production capacity in the form of Giga Berlin and also Giga Texas. If you just look at Norway, Sweden, Denmark, UK, Israel, Singapore, and also South Korea, they have already set a ban on ICE vehicles by the end of the decade in year 2030. And these countries alone have an annual demand of 9.5 million vehicles per annum. Demand is therefore not an issue for Tesla. 4680 batteries and also the latest manufacturing facilities will reduce the cost of manufacturing and therefore increase profit margin. Tesla has negligible debt and also paid up most of its capex for Giga Berlin and also Giga Texas when interest rate was low. In the short term, the stock price may be volatile as we foresee a hike in interest rate, but in the long term, fundamentally this company is worth 1,500 to 2,000 just based on the EV sales alone. Anyway, I hope you learned something today, and also Happy Chinese New Year. Invest safe, take care, I love you guys.